Imagine this. A new AI model drops, and it doesn't just make a few headlines. It actually crashes the stock market. And we're not talking about crypto or some little meme stock here. We are talking about massive, legacy software companies getting absolutely hammered. This isn't some far-off prediction. This is a look at what happens when AI's capabilities take a giant, and I mean giant, leap forward. $285 billion. Just let that number sink in for a second. That is the amount of value that could be completely erased from the market in just a matter of days. It's an absolutely staggering figure, the kind that sends shockwaves all the way from London to New York.
So the obvious question is how? How could a single piece of software, one AI model, cause that much financial chaos? Well, this story is about way more than just a market dip. It's a huge sign of a fundamental shift that is happening right under our noses.
Okay, let's start with the shock itself. Let's just imagine a hypothetical next-gen AI model is released to the public. And this isn't just another small incremental update. No, this thing's capabilities send an immediate, visceral shockwave straight through Wall Street.
You see, these aren't just abstract benchmarks. A high score on something like tax reasoning or analyzing complex SEC filings. These are real-world, high-stakes financial tasks. It proves, right there in black and white, that AI can genuinely replace the expensive, specialized software that big companies pay thousands and thousands of dollars a month for. Suddenly, the threat isn't theoretical anymore. It's very, very real.
So Wall Street reacts instantly. Now let's look at the immediate carnage, which would be swift, brutal, and totally global.
Over in the UK, the data providers would get hit the hardest. Just look at RELX, the owner of that huge legal database LexisNexis. A drop of 12% in a single day? That would be its biggest fall since 1988. Investors see an AI that can analyze legal documents, and they immediately price in a direct threat to RELX's entire core business model.
And that fear? It just hops right across the Atlantic. In the US, financial data companies like FactSet could see a 10% hit. Even Intuit, the makers of TurboTax, might fall almost 5%. The market is connecting the dots in real time. If an AI is acing tax reasoning tests, what on earth does that mean for tax software?
But the bleeding wouldn't stop there, not even close. The fear would spread to the entire enterprise software sector. HubSpot, Oracle, Salesforce, Adobe, all of them down. The market would suddenly realize this isn't just about finance or law. It's about any business that sells access to specialized information or workflows. Now, after that initial wave of panic, there'd be a moment, just a brief glimmer of hope where it seemed like the market might be recovering. But yeah, it would be a total false dawn.
Let's look at RELX again. You have a catastrophic 12% drop, followed by this tiny, almost insignificant 2.4% gain. That's not a recovery. It's a twitch. The panic selling had stopped, sure, but nobody was rushing back in to buy. The damage was done.
This brief stabilization is what traders call a dead cat bounce. The morbid idea is that even a dead cat will bounce if it falls from a great enough height. The underlying threat from this new AI hadn't vanished. The market was just catching its breath before it had to price in a new, much harsher reality.
And this brings us right to the heart of the matter. This wasn't just a temporary panic. This was a permanent reevaluation, what's called a structural repricing of what these companies are actually worth in an age where AI can do what they do, but cheaper and way, way faster.
So there are 4 key reasons why the market wouldn't really bounce back. First, the selling pressure was sustained. This showed a deep, deep loss of confidence. Second, investors started to fear the next AI model release. It's this idea of flow catalyst risk, the fear that today's shock is just a little preview of a bigger one tomorrow. Third, the threat to profit margins was now undeniable. And finally, investors started pulling their money out of software and putting it into other sectors they saw as less vulnerable.
As one analyst put it, the market is pricing in permanent revenue headwinds, not temporary panic. That just hits the nail on the head, right? This wasn't an overreaction. It was the market coming to the conclusion that the future revenue and profits for these software giants are now permanently lower, period.
But here's the thing. This story isn't just about one AI model from one company. The sell-off would be a symptom of a much larger, high-stakes competition. A new AI arms race that is completely reshaping the entire tech landscape as we speak.
So just as the market was reeling from this AI model's impact, another number appears, $1.25 trillion. This is the valuation of a newly merged entity combining Elon Musk's SpaceX and xAI. Just like that, a new titan is born in the tech world.
And Musk's strategy here is, well, it's breathtakingly ambitious. He's not just building AI models. He is vertically integrating everything. He's got the launch capability from SpaceX, the AI development from xAI, and the global distribution from Starlink. And the end goal? AI data centers orbiting the Earth, solving the massive energy and cooling problems that plague Earthbound AI. It's wild.
Meanwhile, you've got other major players making their own massive strategic moves. And their plans aren't just about software either. They're about bypassing the phone completely and owning the hardware platform itself. Get this, their project, codenamed Sweet Pea, is a behind-the-ear device designed by the legendary Jony Ive, the guy behind the iPhone. The strategy is just brilliant, right? If Apple and Google control access to your AI on their phones, well, then you just build your own hardware and go straight to the consumer. This is a fight for platform control.
So, okay, after this whirlwind of market shocks and huge strategic power plays, what does it all mean? What are the real takeaways from all this?
It seems like 4 new rules have emerged. First, the disruption of software as a service is no longer a future prediction. It is happening right now. Second, vertical integration is the winning strategy. It gives companies control over everything from the silicon to the user. Third, specific AI benchmarks now have the power to move markets directly. And finally, the fight for AI supremacy is moving to hardware, bypassing the traditional gatekeepers like Apple and Google.
You know, this all boils down to one incredibly powerful economic force: information commoditization. For decades, companies like RELX and FactSet built empires by selling scarce, expensive information. Well, AI makes that same information abundant and cheap. And that right there is the fundamental reason that $285 billion of value could get wiped out in the blink of an eye.
And this all leaves us with a final, pretty provocative question. For decades, we've valued companies and people based on their specialized knowledge. But what is the value of that knowledge when a machine can acquire it, master it, and distribute it to everyone instantly? That's the question the market, and all of us, are now trying to answer.